Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Want to be able to answer your questions today. We're trying to help people, really with their finances in retirement. We found that this is kind of a lacking area, so we started this channel for that reason. And so what we'd like to do today is to be able to answer questions. So you can send those in live if you'd like during the show here. You can do that a couple different ways. Either send it through the email that's listed here, ask Tom at talkmoneywithtom.com, or if you're signed in on the YouTube channel, you can put something into the chat, and we'll try to answer those live. You can send in questions during the week if you'd like, and we cover a lot of questions that come up in our client strategy sessions and different emails and things, just things we think probably more than one or two people would, be interested in as far as that goes. So, and of course, you can subscribe to the channel. You can hit the little bell button if you want to get notified. Go in and look at all the different videos that we've put in there so far. And then lastly, of course, if you just want to meet with Ethan and I, we can do that also, right? 30 minutes, at your convenience. Our schedule is online. You can go to our website. There's a link here on the channel. At the top of our website is a button, looks just like that, book appointment. And you can schedule a live appointment, phone, video, come in the office, whatever works for you. And so looking forward to today's show. I've got a couple really good, I think, questions already that we can follow up on and try to help people with as far as that goes. I do a video every day. Didn't get as many this week because I was out, but normally Monday through Thursday on the market, and then Friday I try to do a summary. So we'll start off with that. We'll do a summary for what we saw happening this week with the stock market. It's been an interesting week, actually. Here's this overall chart that we've been looking at for quite a while. And so you can see the pandemic in there, the 2022 drop that happened with the higher inflation. The drop that's right over our heads was the Liberation Day, the first, announcements of these tariffs. And really, this week, the market was coming down all week. Right? A lot of big companies, especially retailers, were doing their earnings reports. And I thought the most interesting one was Walmart, because they're kind of a bellwether stock to really see what happens.
Yeah, and this is the first miss in 3 years, I believe.
Yeah, so it's the first time that they missed the earnings expectations, because I think the average right now in the last 3 or 4 years has been like 78%, almost 80% of companies beat their expectations on the S&P 500. So to miss, it's kind of a big deal, and the reason that they missed was because of tariff-related costs. And so what happens there, again, the tariffs are being paid by the company that's importing the good, or the consumer if that company decides to pass along that cost. Walmart's kind of in a tricky spot just because of the fact that they've got, a low cost concept. And so they've decided, at least so far, to kind of eat some of this, tariff cost, and it cost them in their earnings, and it cost them in their stock. They were down about 4% or so, that day as they announced the earnings. And so, but that's going to be very interesting if you think about what's going to happen. I'm fascinated to see all of these reports and what different companies are doing. And because we're starting to see finally the real effects of the tariffs come through. And so if you're Walmart, do you eat more of the tariff and hurt your earnings, which then can hurt the stock price, right? Or do you pass more of the tariff on to the consumer, which then could create what we call demand destruction? When the price gets up high enough, people pull back, right, on what they're buying.
And then you're still, again, hurting your earnings.
And you're still hurting, because now you're hurting your revenue, which could eventually hurt your earnings, right?
Yeah.
You might be passing along. So, companies are going to trying to find that balance between those two. And so that's going to be, what's going on with all of these companies. So I thought that was fascinating, just from a standpoint of, starting to learn how this is going to work and what the impacts are. Because, we're at an 18% average tariff, according to the Yale Budget Lab, across the board. And, it's been a kind of a moving target. Right after Liberation Day, it was 22%, so, and we're still kind of working our way through all of these things as far as that goes. But the big news this week was really the Jackson Hole speech. So the Fed, they meet in July, which we already had, and then they don't actually have a traditional meeting in August. They meet with a together, and a bunch of other, central bankers come into Jackson Hole, Wyoming, and then usually at the end of it, Chairman Powell will give a speech, and it's a little bit different speech. It has potential to move the market quite dramatically in the past, partly because there's no question and answer.
Yeah, you can curate kind of what
Yeah.
message you want to present to the market, and what you want the market to hear.
Yeah, so in 2022, they were really trying to get the market to have trouble, right? Because, what we call jawboning. So one of the ways, maybe I don't, if I'm a Fed Reserve governor, I don't have to raise rates as fast if other parts of the economy are not doing as well. Like if the stock market is falling, and in the end, in 2022, it fell 28% from high to low. That's a way to kind of slow things down, okay? So in this speech today that just happened, things are kind of the opposite, because what they're looking at is a slowing, economy. Mm-hmm. So last year, for example, the gross domestic product was up 2.5%, right? This year, first half of the year, it's up 1.2%. So basically half of the growth, and projected to continue to kind of even slow more as the impact of these tariffs come in. So, the Federal Reserve is trying to keep the economy rolling, but they don't want to get it hot where it creates inflation, right? Well, and of course, last year we averaged per month 186,000 new jobs created. Mm-hmm. This year, 35,000 new jobs created, right? So Chairman Powell was talking about basically seeing the, instability in the employment market, because they have a dual mandate, try to keep employees, employed, and to try to keep inflation, on core PCE down to 2%. It's currently at 2.9%, right? So, and it's been climbing, actually, and we've seen wholesale prices climbing. So we're going to see inflation kind of coming through. So again, the Fed is getting pulled both directions, right? Mm-hmm. One direction says, oh, we should, raise rates because inflation's coming. The other direction says, oh, we should lower rates because, employment is starting to get soft and the economy is starting to get soft. And so, but today he talked about, leaning towards lowering rates. The Federal Reserve is leaning towards lowering rates. And of course, the bet on the market went from kind of in the 70s on a rate cut and, a percent chance of a rate cut in September to, up into the mid to low 90s, actually, for temporarily. So, and so think about that. One of the reasons that they would have to do that, if you're going to choose a side, and let's say you're going to choose the rate cut side, mm-hmm. and you're not going to try to fight inflation, and we'll talk about why that makes sense in a minute, then you want to talk more positively, and you want to use Jackson Hole to try to boost the market. Because again, maybe I don't have to lower rates as much, right? If I can get the economy going better, at least through the stock market or any other types of market. The bond market went up, people have more money when those things happen. So it's very calculated, believe me. There's no question in my mind whatsoever that every word that comes out of these Fed governors' mouths are generally exactly on some type of, concept of what they're trying to accomplish at that point in time. And so the market's up almost 1.7%, 1.6%, something along those lines as we speak, or at least when we started the show, and makes for a positive week, even though we had down days almost every day.
Yeah, and we're right at near the all-time high. So.
Yeah, exactly. And not surprising. So the Fed is trying to help. Now, let's talk about the other side. The reason you would choose to try to help the employment side of your dual mandate instead of the inflation side is because normally when you're when you're lowering rates, the danger is you are stimulating more buying, right?
And with the demand, you generate more inflation.
Right. But demand is dropping. Overall retail sales are down for this year, for example. Corporate spending is down a lot, actually, for this year. CapEx spending is down also. So really, the inflation that is normally being caused by an economy that's too hot, or consumers that are too interested in spending, or businesses that are spending too much, that's how inflation normally happens, but that's not what's happening here. What's happening here is inflation is being caused by a tax, mm-hmm. right? we're taxing goods coming into the country, and we're passing that along, and some of that's going to end up, if not a lot of that, is going to end up in the price. We saw that in 2018, price went up. Almost all of the tariffs were passed through in 2018, for example, and even the domestic producers raised their prices up also, even though they didn't have a tariff, because they could. And so that's a, first of all, it could be, and they talked about, Chairman Powell talked about this, it's a one-time thing, theoretically. It depends on what happens. If, what's going to happen next year and the year after with these tariffs? Are they going to get worse? It's possible. It seems like they're still adding things. They added more this week of 400 line items that they included as part of the steel, aluminum, and copper piece. So like a fire extinguisher and what tariffs, and so they're really going after. They're still broadening these tariffs and trying to grab more money, out of the system. So if your inflation is being caused by a tariff instead of being caused by demand, and if demand is actually dropping, it gives you room to lower rates. And they probably could do it again next month after that, and whatever happens, because there's not a lot of risk of creating a massive inflationary bubble on a demand side because rates are lower. But it might help the economy to stay out of a recession and keep the job market more stable as far as that goes. And Powell did talk today about things can get out of hand pretty quickly.
Yeah,
Right?
one thing that was also interesting, he was talking about how the labor market is kind of changing because of demographics. You have a lot of people retiring out of the market, and then you also have limited incoming. As you limit immigrants to the nation, you're also limiting the amount of people that can take jobs.
That's right.
And so even if you're creating little jobs, if there's little growth in the actual labor force, then
Right.
it's okay too.
Yeah, that's right. Yeah, exactly. I mean, if the labor force is growing dramatically, through new births and through immigration, you've got to have new jobs or you're going to end up with a very high unemployment rate, right? So, and unemployment has been creeping up, but still is in the kind of reasonable level, although it's a big lagging indicator. So, anyway, that I thought, those pieces are quite interesting in terms of, how this market is reacting to all of this as far as that goes. And, we did see kind of a tech sell-off this week at the beginning, a rotation into defensive sectors that were doing well. Value stocks were doing better. People were nervous about this speech. There's been some periods of time. I remember in 2022, the market dropped over 3% after the speech. And again, that was on purpose. That's what they want. I think this is what they want here, right? Certainly, after hearing it, you realize, oh, okay, they're leaning towards rate cuts anyway. So maybe we don't have to do a bunch of rate cuts if we can get the market to kind of create some
and
wealth feeling.
You saw a lot of companies that depend on basically financing, so home builders, energy, were all running because they need debt to grow.
Yeah, that's right. Yeah, companies that use a lot of debt or their consumers use debt, like a mortgage, those types of things. We're looking at those. Those are up 5, 6, 7% today. So the rate cut concept is overall a great idea. However, the one piece you have to consider here is, and this is, Martin Zweig had a book that I read a long time ago, and he had a whole chapter in there called "Don't Fight the Fed." So when the Fed is lowering rates, right, you basically should be, invested.
Yeah, as much
right?
as possible.
Right. Of course, the problem is that the data that we're looking at doesn't go back to the last time we had tariffs this high, mainly because you're looking at a stock market that's so different than today's market, and that was back in 1930, and it's basically the Great Depression. And so, don't fight the Fed, does that outdo high tariffs, right? This is the whole thing is all about this. If you take a bunch of people out of our workforce through, deportations, and you add these tariffs, that's on one side, right? That's going to slow things down. That's going to create economic potential problems. And on the other side, we have artificial intelligence, which has been very exciting. It's been really driving things. NVIDIA is going to be doing their earnings, next week. That could be a big push. It has been in the past, although the bar is getting higher and higher and higher. Yeah. And I think even if they jump over it, it's going to be hard for the market to get super excited like they did, kind of the first few times that they did it. But nonetheless, so that's an exciting part for the market, right? Combined with, rate cuts that are happening, right? And so who wins here, okay? There's no data. right? How many times have we had this type of deportations? There's some data, right? And it's generally been inflationary, okay?
Yeah, and you're starting to see it in very labor-intensive goods that tend to be of immigrant labor.
Right.
So produce
Produce, yeah.
is getting
I
expensive.
think raw vegetables went up 38.9% year over year in the last report.
And I've been hearing like, construction like roofing and stuff like that, their pricing is going up too.
Yeah, and so it's because you can if you know, basically if you reduce the supply and the demand stays the same for roofs, for example, and you can't do as many roofs because you don't have as much labor, you know, as a group, as all the roofing companies, the price is generally going to go up because it can, and so that's happening.
And unfortunately, those jobs aren't replaceable by AI. So even if you
Yeah.
use those jobs, even if you use AI, you can't replace a lot of those jobs.
Apparently, they're not even replaceable by American citizens either, which is part of the problem. And so, even in Florida, I've been reading articles that farmers are complaining they can't get American citizens to come out and pick the crops and do the labor. You know, they get very, very few applications, even though they're paying, you know, an okay wage. I wouldn't do it, but it's, you know, it's tough.
Yeah, I've also heard that some farmers are just trying to stave off wasting crops. Is they're actually planting less because they're not sure if they can harvest everything.
Yeah, so that's the conundrum here. Stock market's at an all-time high nearly, right? Looks pretty good. Look at that chart. If I didn't know about tariffs and all the other things that are creating problems, I'd have no problem with that chart, just like we didn't have problems when it dropped back in, you know, the summer of 23. We stayed in and we continued to go because, you know, the metrics made sense. And I think this market right now and the participants in this market really, you know, are banking on tariffs being a minor issue, which it could be, very much so. Could be something that isn't such a big deal, could be a one-time effect. It's just in the past, if you go back far enough, when we've had tariffs at these levels, it hasn't been good, right? And they don't stay at this level very long, which again could be another good thing. Maybe it falls off pretty quickly and we get back to normal, but it seems like they're just going the other way. We're continuing to add tariffs, continuing to, you know, all of a sudden Brazil's at 50%, and well, we're pissed off at India for selling Russian oil. Actually, it's kind of funny. It's actually two private companies in India are arbitraging Russian oil.
Mm-hmm.
They're buying it and then reselling it at whatever the cap is, $60 a barrel, and they resell it at whatever. And so they're going after the entire country with a 50% tariff because there's two private companies deciding that they want to try to take advantage of the situation, which is kind of bizarre, but nonetheless. And then China, of course, is doing the same thing. Well, I don't know if China's not doing the arbitrage as much. They're buying Russian oil.
They're basically keeping it in
They're using it.
Yeah.
Yeah. Because I know, you know, that's what they're basically doing, arbitraging the oil. And anyway, so, you know, it's become this thing where we don't know that it's not going higher, that's for sure. Especially if it seems like everything's okay, which it does at the moment, right? All right, so anyway, that's our summary for the week. You know, the market's doing great. The bond market's up. There's some really good things happening altogether. Hopefully things continue to roll forward as far as that goes. But we're, you know, still being a little cautious, trying to see how these tariffs are going to unroll and hit these earnings, you know, and how that's going to happen, what's going to happen to the labor market and such too. And because it can easily tip. I've been doing this for a long time. And the one thing I realized is that before you know it, you could be going downward pretty hard on the economy, on employment, and different things on those lines. And what we have discovered is this ability to send out stimulus checks and do all those types of things. I'm not so sure we have as much money to spend right now with the deficits we're already running, and the bond market might really not like, because they've talked about sending out checks, you know, tariff checks to kind of stimulate things, which I think would be a good idea, other than the fact that it would create more debt, which I don't like, and it would create a bond market that might really struggle with that.
Yeah, especially since like the last tax bill just added so much to the deficit already. So
Right.
the bond market is always feeling stretched.
Right, exactly. All right, good. Well, let's start up with our first question.
So what adjustments are you thinking about for the portfolios after the Jackson Hole speech? Or do you think there's any change you want to make, or you can kind of stay in the course?
Yeah, it's a good question because, you know, we have 1/3 of our normal allocation out of the stock market. actually we're a little less than that now because our stock market portion has grown as it's come back, but nonetheless. So I still feel like a 2/3 in and a 1/3 out is kind of a reasonable scenario. The T-bills are still doing well. They're still paying well. We'll see what happens as they cut rates. Those will come down too. But what 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 concerns me is that the data set that we're all operating on. So AI is just like the .com. We should get a big old boom just like the .com. I agree, actually, and that seems to be happening. And we're not even close to being at the end. I'd say, if anything, we're in the middle innings at best of the run that would come out of that, because we haven't got the stupid piece that's going to happen at the end of this. Watch.
Yeah,
It's starting.
Someone's gonna start putting like bingo.ai or
Yes.
something like that, where they just attach AI to their name.
Exactly. We're not there yet. We could be there by next year even, and we'd probably be there a lot faster if it wasn't for some of these tariffs and such too. But we don't have a game plan for how to handle tariffs because it doesn't happen enough, right? To see what can happen. We had small tariffs done in 2018. Those we didn't respond to those at all. We kept right in there, rode right through all of that because it was a really small amount of money altogether. This is huge. It's the entire world. It's what a minimum of 15% seems to be up to 50% tariffs. Got China is up there. Got some of our big trading partners, Canada, Mexico, really amazing. So I think that I still want to see where the impact's going to be and how that's going to transpire as these prices go up. How much does that impact? Because what happened in 1930, unemployment went from 6% to 25%. So different time frames. This is not a depression. They were already started the depression by the time they started these tariffs. But nonetheless, it has a potential impact on employment. And we've already seen that. Even without the tariffs really hitting, we've already seen employment soften up from 186,000 new jobs last year to 35,000. There's some other potential reasons for that without lower immigration and what have you too. However, that that's just because of all the confusion, right? The chaos is creating a scenario where people don't want to spend money as much and companies aren't spending the money as much. So yeah, I'm still in the same boat. I'm really against not following the Fed, so I'm struggling with that part. When the Fed lowers rates, I want to be in. But that was because every time they lowered rates in the past, we didn't have tariffs sitting, here.
Yeah, and they haven't lowered the rates actually. It's
No.
just, we still have till September for them to actually have the possibility.
That's
of it.
true. There could be something that comes through in one of these, because we're going to get September 17th, right? So we're going to get another PCE report here at the end of the
And then
month.
we should have one more CPI.
And one more CPI. That's right, before. And so, we saw CPI come up this month, which usually means PCE is going to follow suit. Not that dramatic, but what we really saw was the wholesale inflation was up a lot. And so, we'll get another PPI report also. It usually comes the day after the wholesale inflation. So, yeah, it's possible that they don't do a cut. I think they will and can, because if you just ignore the fact that prices are going up because of tariffs, prices might not be going up otherwise. And so you can lower rates, create more demand, still doesn't change the inflation picture that much because most of that inflation is being pushed through by higher costs and at this tax, this tariff tax. So, but the overall impact of what that's going to happen and the possibility of putting a financial system, a global financial system, under tremendous pressure, there's a higher risk there. It just is, and so that's how I view investing. It's about probability. So what's the probability that the market is much higher a year from now than it is now? And that probability is down from my view in 2023 and 2024 because of tariffs and deportations. And we'll see if that turns out to be warranted or not. But it seems logical, right, to me. I mean, it just does. the market doesn't always operate in that zone, but it generally gets back to that zone. Logic eventually plays through the market,
But,
over the longer term.
yeah, but the market also plays on greed and fear too.
Mhm.
So in
Yeah.
intense moments, you'll have very much a greedy period and a very fearful.
Yeah, exactly. So it's, I hope we're wrong. I hope the market just goes and tariffs don't mean anything and we'll get back in. I'm fine. We're doing okay, And so anyway, that's where that's a good question. What's our next one?
So, what are my options to lower my premiums for my long-term care? I received a letter saying that they're going to raise the premium over the next few years, and I can afford it, but it's feeling so expensive, especially for something that I could possibly not use.
Yeah, so this is something that's been happening over the last several years with clients getting letters from the long-term care insurance company that they have talking about increasing, the premiums. And so one of the problems with long-term care is that, they sold it. It's a relatively new concept, long-term care insurance. Didn't have it 20, 30 years ago as much as we do now. And so the companies were selling to like 40-year-olds to 60-year-olds, all these policies, making money. And of course, the premiums were essentially competitive. They were competing with each other. So, they were driven down. Well, the reality is now this group is getting into, actual nursing homes and long-term care scenarios, and they're starting to pay money out in a big way. And of course, the cost for long-term care has really gone up. And other situations, they've made inroads on strokes and cancer and heart attacks, which are the three biggies, right? Which means that people live longer, which has exposed the dementia and the Alzheimer's. So memory care is the fastest growing segment, and it's the most expensive, right?
Yeah.
And so these companies are paying more. Now, the companies, generally, what's happening is they're capped, right?
Yep.
So it isn't so much that it costs more, it's that more people are ending up in long-term care because they're not dying from stroke, cancer, and heart attacks.
So they're having to pay out more often than they were predicting.
That's right, and they're having to pay out longer because a lot of times with just those particular with Alzheimer's or dementia or Parkinson's or whatever it might be, life expectancy is shortened, but not like a stroke or a cancer type of scenario. So they can pay out for a longer period of time, and people certainly get past the elimination period, all these things. So just giving some backdrop for kind of what's happening. And so it's interesting that being in California, they've got the insurance department here has some regulations on how much they can increase and what have you, and they're having to get like this approval.
Yeah, they basically do a proposal, and then usually the insurance board will come back and say, "Hey, we think this is too high. We'll give you this amount."
Yes, and so clients have been calling and saying, "Okay, they're asking for a lot of money. Can I afford that? So we can put it in their plan and see how that works." And then they give options, right, on how to, how to give up some of your benefits,
Yeah.
essentially, in exchange for keeping the price increase down. Sometimes it can be zero, keep it the same, but you got to give up
Or you
more.
get a lower premium.
Yeah.
So it's basically, you have a couple levers. You have the elimination period, you have the benefit per day amount, the benefit period, and then also the inflation protection. So those are the kind of the four ones that most options will have. And so you can lower that. So you can say, "Hey, I have a 4-year benefit period. I'm going to lower it from 4 to 3." And so you'll get, basically, you lose about a quarter of your benefit, but they'll lower the premiums quite a bit for that.
Yeah, so the elimination period is how long you have to pay for it yourself before they'll kick in. Usually it's like 30 to 90 days.
Yeah, that's kind of the common period.
Right, and you could go longer. You could choose, okay, I could afford it for 120 days or whatever they're offering, and that would possibly, it's not so much lowering your premium, it's lowering your increased premium
Yeah.
to try to get it back down. I believe actually in some of those, if you took all the options, you could actually lower your premium versus what you're paying now in some cases. But yeah, you might have a 5% inflation, protection on there where the benefit is growing at 5% a year to keep up with some of the costs of higher long-term care, and maybe they give you an option to drop that down to 1%. Right?
Yeah, yeah, and especially if you're, up there in age, in your mid to late 70s or early 80s, maybe you can give up that inflation premium because you don't need it as much.
That's right. Yeah.
So you could switch to maybe say, hey, instead of doing compound 5% each year and allow it to keep compounding, let's just do simple 5%.
Right.
So I still get some increase, but it's only that 5% on that is set,
Right.
benefit amount each year.
Yep.
Or you could say, hey, I just want the lowest possible, which is compounding of 1%. Let's just lower it. And so the pros and cons of that is like, if you don't need the policy, you're paying less premiums. And then but you're taking on that risk that you're going to have to pay more later on if you have to have one.
Right.
But the issue is we don't have a crystal ball. So I can't tell you for 100% certainty that you're going to need long-term care. Because if you were able to predict that 100% certainty, these policies got to be out of business pretty much.
That's right. It's the problem. Yeah. Here's the issue, though. I mean, so here you are, in your 70s or 80s, and this company's coming to you and saying, now you got to pay more,
Mm-hmm.
And the problem is you've already been paying. Maybe you got this policy. I looked at one situation. They had $75,000 in premiums that they'd paid so far. So it's kind of like this investment. And so, do you drop it on the off chance that you don't need it? You've just spent $75,000. It's a weird calculation because technically it's the same thing like auto insurance. I hate to add up how much I've paid in auto insurance.
The nice thing with long-term care insurance is if you do you will always have the paid up option where you pay no more premiums and they will give you a benefit.
Yeah.
The benefit is substantially less. It's
Yeah.
based on just how much premiums you paid into the policy,
Right.
but they'll give you something. So
Right.
if nothing, your premiums have not gone to waste with that.
Right. Yeah. So you're deciding whether you want to continue to invest in those higher options,
Yeah.
And so can you afford it? Should you do it? Should you do it? Probably. I mean, it is weird. I've seen, the cost of long-term care here locally go up amazingly. I've heard numbers that just blow me away, $18,000 a month. And so long-term care insurance isn't going to pay $18,000 a month.
But it's going to help make a dent in that.
Yeah, usually those policies are somewhere in that kind of 300 to 800,000 lifetime payout. From what I've seen, I'm roughing that a little bit, and so they'll help, and those clients that have needed them in past, wow, they're really, really happy that they have those, and they're still having some out-of-pocket expenses and what have you, but to have that there, that's enough for me to say it's a good thing to have, and it is a growing problem too. You have a higher probability of being in long-term care than we used to be, just because again they've kind of made all these inroads on these other things that keep us from aging.
Another thing is, especially if you're a couple, if you have a long-term care event for one person,
Yeah.
without insurance, you could also be draining the assets for the other person.
Yes.
And so it's also protecting your spouse, too, or
Yeah.
your partner.
Yeah, it's too bad. I mean, honestly, I feel like this is a big, giant hole in this country's, overall look, and we've actually are going the opposite direction with the big, beautiful bill. They're cutting back on Medicaid, which is one of the avenues that is being used for some long-term care recipients. And it's, I just feel like this is a country that has enough wealth that we should be able to, provide care throughout the lifetime. I mean, why have such a successful country with such a huge economy, the best in the world by far, and then not be able to kind of help people with their medical, and looking at it as just this pure expense and freeloaders that are getting it or whatever. I feel like, because I've been through this a lot with clients, it can be really devastating. So, it'd be great, pay some policy or pay into a system or whatever it is. But it'd be nice to have something that was there. We have something, but you have to pretty much spend down all your money. I mean, there's a safety net there. So after you're broke and after your spouse who's now, in trouble at home. And California has some better protections for what they call Medi-Cal, which is the safety net for the spouse, which is good as far as that goes. So they've come a long ways. But this is something, just as a as a statement, I really feel like we have a big hole here in terms of how we set things up. So anyway, all right, what do we have for our next question?
So, how can we be in a world of tariffs as well as monetary policy and trade uncertainty and still have stocks at a near all-time high when the world is also moving towards a stagflationary direction? So it's like it feels very counterintuitive to see this all-time high when you see so much uncertainty in the market.
Well, a couple things. Got to always remember the market's looking forward, right? It's so, yes, if you look at last year, we were at 2.5% GDP. This year so far at 1.2% GDP. But the market is looking forward in the next 3 to 18 months. And so typically the market is right when it is going up. Matter of fact, I'd say almost every time the market is right. Is why it's one of the leading indicators out of all the indicators out there. The S&P 500 is included as one of the 10 in the basket of what's called the LEI, the leading economic indicator, because it's quite successful at predicting what's going to come at us. So when you see a stock market going up, what it's saying historically is that in the next 3 to 18 months, things are going to be better. That stagflation will get through it and come out of it. We'll have growth. We're going to have this artificial intelligence piece that's coming in that's going to create productivity. Somehow it's not going to create demand, job destruction. They're basically just job movement, or people that have jobs will be able to do more with, whatever it might be. There's a lot of really exciting things. And the U.S. is sitting on, probably a really good leadership-ish role in that artificial intelligence arena. However, the problem that we're having right now is that in all of those times when we look back, because a lot of these studies start with at the end of World War II, so 1947 to now, or whatever it might be, or go back to when the S&P started, 1957. Mm-hmm. There was never high tariffs in any of, so the market was right, but it never had to deal with tariffs. And the market participants, including me, don't really know when you get to this level, when you have global tariffs, when you have an average tariff at the 18% range, wow, and maybe even going up from there. So I think that's the disconnect for me, and I think that's why there's a disconnect. Market goes up, it has momentum, people get in and they keep going, and that works really well. It worked well in 23, it worked well in 24, it worked well all the way through the pandemic. It works great. However, I think that everybody's jumping in there with either they think tariffs, either they don't think about tariffs, or they think tariffs aren't going to be a big deal somehow, or they think that the tariffs are going to come down when they need to, right? Those are three options. If I was buying in this market and excited about it, those are one of those three would have to be somewhere in my head to allow me to say, okay, I'm going in at this high price because we're now priced for perfection. The Shiller PE ratio is way above 30. It's at 39 right now. Yeah. It's only been it's the third highest in history going back to 1800. So price to earnings ratio is really high on that, because Shiller takes a 10-year average of the earning ratio, and it's can go higher, and it probably will. In the .com thing, it went up to 42 before it crashed and the market crashed. And we're kind of like that. Honestly, I think that's be a path we're on. Take out tariffs, I think we're blowing up to the upside. I think we're going crazy.
You think it's more kind of like a 2000.com
yes,
kind of bubble
definitely.
With AI?
Yeah, we said that last year and the year before, right? I mean, we were plotting out what was happening in 95, and you look at what was happening at the beginning of 24, 23, And so, yeah, I really feel that's a strong possibility, but the tariff is a totally different situation, right? The market participants don't know what can happen with this, and it's still kind of confusing, and there's a lot that still depends. It depends on who pays those tariffs. Is it companies? Are they companies that are able to absorb that, even though if they have less earnings, they're still not a big market participant. It's not affecting Microsoft, Apple, these other companies. So Apple's probably a bad example because I think they're going to get affected. But
yeah, and I think the thing with the stock market is there's also a disconnect from small businesses, because
yes.
a lot of small businesses are going to be tariffs have a bigger impact on a small business than it does on
Right.
like a large corporation with a lot more cash.
And they're the biggest employer. I think 80% of people work for small business, and so does this become a big deal with layoffs? And there are more bankruptcies being recorded right now than we've seen in a really long time. There's a whole bunch of little warning signs coming at us from, and so does this overall economy roll over into the negative side and take down the Microsofts and what have you? Just because yes, they're not directly impacted by tariffs, but they are impacted by a big recession. And does that, like Jamie Dimon was talking about, does that big recession uncover something like private credit, which is huge? And so a lot of this funding that's been happening is becoming through private credit, and the standards for underwriting are not as regulated as they are for some of these other things. Like it's sort of like what happened with the mortgages, that as highly regulated now, but in 2008 they were giving mortgages to anybody, and now you've got to prove it more.
Yeah.
And we've seen that within our practice. And so yeah, that's where it's really that's why how you make sense of it. If you take out tariffs and you take out the assumption or even the knowledge, take out the knowledge of what it could do, you've got a market just like this. There's no reason why not. I mean, things are actually really potentially good in the next 3 to 18 months. So that's where I think that's the only disconnect. And actually, I guess I'll throw in the deportations. We really don't know the full impact, because the irony is that the actual deportations are less in the first 6 months of the Trump administration than they were during the first 6 months of Biden and Obama's administration. However, the way that they're being done, and the scary factor, and the guys with no identification, just mask, in some cases pulling people out of cars, or going to immigration centers, and picking them up right after court. They're trying to do what they're supposed to do, right? And so people are just not showing up. They're not showing up to work, and that's actually more effective not in deporting people, but more effective at possibly increasing
slowing
price.
down the market.
Yeah, it's so. Those are a couple big headwinds the market's not used to. I don't know that that's being factored in yet, and maybe it doesn't need to be. Maybe the market will be right again, but I don't feel like there's any way. I don't think you can take what's happened in the past and say, oh, every time the market goes up, I should get in because it keeps going and it is a precursor to a better economy. I would normally be in that boat 100%, but this differential with the deportations and the tariffs is enough to say, hey, let's at least have a third out and see what happens. Well, it seems like a reasonable look at it, but that's why, the market keeps going. I think there's no realization within the market at this point in time. Maybe everybody who does realize or feels that I do is already out, and so the people that are left in there are just like, hey, it's artificial intelligence. It's these things that are going to drive things.
If the sellers are out, then
Right.
there are only buyers left.
Yep. The small retail investor has no idea what's going to happen with tariffs any more than we do. But it is, something to be aware of and maybe cautious about. Okay, that's good. Let's call it a day. Appreciate everybody for joining us today. Great questions. Send in some more questions. Love to answer them. If you have a question, likely somebody else might have a similar question that they want to have answered also. So you can send it during the week to asktom@talkmoneywithtom.com. We'll be here next Friday again, and we'll go over that. Of course, go look at the channel, continue your education. You'd be surprised how much more comfortable your retirement can be if your finances are in really good order, no matter how much money you have. If you have a little bit of money or a lot of money, the more you know and the more that you can maximize your situation, how to do the planning, better decision-making processes, what to do about taxes, how to manage the money in that retirement time frame, all of these things. So there's a lot of content on this channel, how to do Roth conversions, whatever it might be. So visit that, subscribe, hit the bell button. And then, of course, if you just want to speak to us and ask us your questions in person, you can book an appointment, which is there on our website. And again, in the office, phone call, video, whatever works for you. So look forward to being able to see you again next week, and thank you so much for coming today.